the core message behind the video. At its core, this video is not simply about earning $1,000 per month from dividends, but rather about teaching viewers how long-term wealth is actually built through patience, realistic expectations, disciplined investing, and intelligent risk management. The creator carefully frames dividend investing not as a magical shortcut to financial freedom, but as a slow and deliberate process that rewards consistency over excitement. One of the strongest aspects of the video is how it immediately dismantles the fantasy many beginners have about passive income. In today's social media environment, people are constantly exposed to exaggerated claims about easy money, financial freedom in a few months, and overnight investing success. So the video intentionally positions itself against that mindset from the very beginning. Instead of promising viewers instant riches, it repeatedly emphasizes that generating reliable monthly income from investments requires either significant capital, many years of compounding, or both. This creates credibility because the speaker sounds grounded rather than overly promotional. Another major message throughout the video is that sustainable wealth matters far more than chasing unrealistic returns. The creator explains that many inexperienced investors become obsessed with finding the highest dividend yields possible because they assume higher percentages automatically mean better investments. However, the video introduces a more mature perspective by explaining that unusually high dividend yields often signal hidden problems inside the company itself. In many cases, a stock's yield becomes extremely high because the share price has collapsed due to weakening business conditions, investor fear, declining profits, or financial instability. As a result, what initially appears attractive may actually be a warning sign. This is one of the most valuable educational elements in the entire video because it shifts the viewer's focus away from greed and toward sustainability. Rather than encouraging speculation, the creator promotes the idea that reliable, moderate dividend-paying companies are often far safer and more effective over long periods of time. The video also subtly teaches viewers that investing is not purely mathematical. It is deeply psychological. Throughout the discussion, the speaker acknowledges that many people are emotionally attracted to the idea of receiving regular dividend payments because it feels tangible and rewarding, almost like getting paid without working. That emotional satisfaction can motivate people to stay invested during difficult periods, which is an important but often overlooked factor in successful investing. At the same time, the creator avoids becoming dogmatic by admitting that growth investing can sometimes produce faster wealth accumulation than dividend-focused investing. This balanced viewpoint makes the content feel thoughtful and realistic because it avoids portraying one strategy as universally superior. Ultimately, the true message of the video is that financial independence is achievable for ordinary people, but only through time, discipline, reinvestment, and a willingness to think long-term instead of searching for shortcuts. The psychological hook and emotional opening strategy. One of the most effective aspects of this video is the way it immediately captures the viewer's imagination through emotional visualization, rather than technical financial explanations. Instead of opening with statistics, charts, or complicated investing terminology, the creator begins with a calm and relatable scene. Someone sitting at their kitchen table on a quiet Tuesday morning, drinking coffee in pajamas, when suddenly their phone buzzes with a notification that $1,000 has just been deposited into their bank account. This opening is incredibly powerful because it transforms the concept of passive income from an abstract financial idea into a vivid emotional experience that viewers can instantly picture themselves living. The audience is not merely being told about dividends. They are being invited to emotionally step into a future version of their life where money arrives automatically without stress, overtime, or constant labor. That emotional framing is extremely important because human beings are naturally more motivated by imagined lifestyles and feelings than by numbers alone. The scene feels peaceful, comfortable, and free from financial anxiety, which directly taps into the deeper psychological desires most viewers carry beneath the surface. The creator understands that people are not truly chasing dividends themselves. They are chasing the emotional freedom those dividends represent. They want security, flexibility, independence, and the ability to enjoy ordinary moments without worrying about bills or exhausting work schedules. By opening with such a relatable image, the video immediately establishes emotional engagement before transitioning into financial education. Another smart element is the packing of the introduction. The creator does not instantly oversell the dream or claim that financial freedom is easy. Instead, after building excitement, the video quickly grounds the viewer back into reality by explaining that this outcome is achievable but requires patience, planning, and realistic expectations. This balance is crucial because it prevents the content from sounding like a typical get-rich-quick scheme. Many finance creators lose credibility by focusing entirely on luxury lifestyles, fast money, or unrealistic promises, but this video intentionally avoids that trap. The speaker creates trust by acknowledging that dividend investing takes time and that substantial income generally requires significant invested capital. This technique is psychologically effective because viewers become more likely to trust someone who openly discusses limitations and challenges rather than someone who only sells excitement. The creator is essentially using a strategy known as balanced aspiration, where hope and realism are combined together. The audience is encouraged to dream about financial independence, but they are also reminded that sustainable wealth comes from discipline rather than shortcuts. Throughout this opening section, the language also remains conversational and humorous, which helps reduce the intimidation many people feel toward investing. Financial topics can often sound cold, technical, or overwhelming to beginners, but the creator deliberately uses simple metaphors, casual jokes, and everyday examples to make the subject feel approachable. This relaxed tone increases audience retention because viewers feel as though they are learning from a knowledgeable friend instead of listening to a formal lecture. In many ways, the emotional opening functions as the foundation for the entire video because it establishes both the fantasy viewer's desire and the realistic mindset required to eventually achieve it. Understanding dividend yield and why high returns can become dangerous. After establishing the emotional appeal of passive income, the video transitions into one of its most educational and financially important sections by explaining the concept of dividend yield and the hidden dangers behind chasing extremely high returns. This portion of the video is particularly effective because it takes a financial concept that many beginners misunderstand and breaks it down into simple, relatable language that feels easy to absorb. The creator explains that dividend yield is essentially the percentage of an investment that gets returned to shareholders annually through dividend payments, functioning somewhat similarly to interest earned from a savings account. However, unlike a bank account backed by stable institutions, dividend payments come from real companies whose businesses can either succeed or struggle over time. This distinction becomes the foundation for the video's central warning. Not all dividend yields are created equal. The speaker uses an excellent analogy by comparing unusually high dividend yields to heavily discounted merchandise in a clearance sale. At first glance, something marked down dramatically may seem like an incredible deal, but often there is an underlying reason why the price has fallen so much. In the investing world, the same logic frequently applies to dividend stocks offering abnormally high yields. Many inexperienced investors instinctively assume that a stock paying 10 or 12% annually must be superior to one paying only 3%. But the video carefully explains why this thinking can become extremely dangerous. In reality, a very high dividend yield often occurs because the company's stock price has collapsed due to financial problems, declining earnings, poor business performance, or weakening investor confidence. Since dividend yield is calculated relative to the stock price, a rapidly falling share price can artificially inflate the yield percentage, making a troubled company appear more attractive than it actually is. This is one of the most valuable educational moments in the entire video, because it introduces viewers to the concept commonly known as a dividend trap or yield trap. A stock may appear to offer incredible passive income potential, but if the business itself is unstable, the dividend payments may eventually be reduced or eliminated entirely. The creator reinforces this point by explaining that sustainable dividend investing is not about maximizing immediate income at all costs. It is about finding companies capable of continuing those payments consistently for many years into the future. That subtle shift in mindset is extremely important because it teaches viewers to think like long-term business owners rather than short-term gamblers chasing flashy numbers. The video also does an excellent job of steering viewers toward more realistic expectations by suggesting that stable dividend yields between roughly 0.5% and 5% are generally healthier and more sustainable than double-digit yields. Although these lower yields may initially sound less exciting, the creator frames them as part of a responsible wealth-building strategy designed to prioritize reliability over speculation. This is psychologically important because many beginner investors are naturally attracted to excitement, but sustainable investing usually rewards patience instead of emotional impulses. Another reason this section works so well is because the creator does not rely on complicated financial jargon or overly technical explanations. Instead, the information is presented through storytelling, humor, and relatable comparisons, making the lesson memorable even for viewers with very little investing experience. By the end of this section, the audience begins to understand that successful dividend investing is not about finding the highest-paying stocks possible, but about balancing income, safety, business quality, and long-term sustainability. In many ways, this part of the video serves as the intellectual turning point where viewers move from fantasy-driven thinking into a more mature understanding of how real investing actually works. The real mathematics behind earning $1,000 per month in dividends. After carefully preparing the audience psychologically and explaining the risks of blindly chasing high yields, the video moves into the practical mathematical section, where the creator finally answers the central question. How much money is actually required to generate $1,000 per month in dividend income? This is where the content becomes especially effective because it replaces vague financial dreams with concrete numerical reality. Many people fantasize about passive income without ever calculating what it truly requires, and the creator uses this section to close the gap between emotional desire and financial practicality. The video begins by simplifying the goal into annual income terms. Since $1,000 per month equals $12,000 per year, the required investment amount depends entirely on the dividend yield of the portfolio being used. This straightforward explanation immediately helps viewers understand that dividend income is essentially a mathematical relationship between capital and yield, rather than some mysterious investing secret. The creator then walks through several different investing scenarios to demonstrate how dramatically the required capital changes depending on the chosen strategy. The first example focuses on a conservative dividend-focused approach using stable, established companies or diversified dividend funds yielding approximately 3% annually. These are described as the boring but reliable types of businesses that may not dominate financial headlines, but have long histories of consistently paying shareholders through both strong and weak economic environments. Examples include utilities, major retailers, and mature blue-chip companies that prioritize stability over explosive growth. Using this approach, the math reveals that an investor would need approximately $400,000 invested in order to generate $12,000 annually in dividends. The creator intentionally pauses on this number because it sounds intimidating to most viewers, especially beginners who may not yet possess substantial savings. This moment is psychologically important because it forces the audience to confront the reality that meaningful passive income generally requires either large amounts of capital or many years of disciplined investing. However, instead of allowing the number to discourage viewers completely, the creator immediately reframes the situation by explaining that dividend investing is not merely about the current income generated today. Many quality dividend-paying companies gradually increase their dividend payments over time, effectively giving investors a form of automatic financial raise without requiring additional labor. This idea becomes one of the most motivating concepts in the video because it introduces the audience to the long-term power of dividend growth. Companies that consistently raise their dividends year after year can significantly increase an investor's income stream over decades, even if the original yield seemed modest at first. The creator uses this point to shift attention away from short-term gratification and toward long-term wealth accumulation. The video then explores an alternative strategy centered on growth investing. In this scenario, the investments pay very small dividends, perhaps around 0.5% annually, but are expected to appreciate in value much faster over time. Here, the mathematics become almost shocking because generating $1,000 per month solely from those low-yield dividends would require roughly $2.5 million invested. This dramatic comparison serves an important educational purpose. It demonstrates that growth-focused investments are generally inefficient for producing immediate passive income through dividends alone. However, the creator cleverly explains that these faster-growing investments may still help investors reach financial independence sooner, because the portfolio value itself could grow rapidly enough that investors can periodically sell small portions of their holdings for income, instead of depending entirely on dividend payments. This introduces the concept of total return, even though the phrase itself is not heavily emphasized. The creator is subtly teaching viewers that wealth accumulation and income generation are related but not always identical objectives. The video then presents a middle ground strategy using investments that balance both moderate dividend income and long-term growth potential. With yields around 1.5%, the required investment falls somewhere near $800,000. This balanced approach is framed as potentially the smartest option for many investors because it avoids the extremes of both purely conservative dividend investing and purely aggressive growth investing. One of the strongest qualities of this section is that the creator never pretends there is a perfect universal strategy. Instead, each approach is presented with trade-offs involving risk, growth potential, required capital, and psychological comfort. This makes the content feel far more credible because real investing decisions are rarely simple or one-dimensional. Ultimately, this mathematical section transforms the viewer's understanding of passive income by revealing that sustainable dividend investing is less about finding secret shortcuts and more about understanding the relationship between capital, yield, growth, and time. Specialized dividend strategies, REITs, sector investing, and the temptation of higher income. After explaining the more traditional and balanced approaches to dividend investing, the video moves into a more exciting but significantly riskier territory by discussing specialized investment strategies capable of generating higher yields with less upfront capital. This section is particularly important because it explores the emotional temptation many investors experience when they realize how large the required capital becomes under safer dividend strategies. Once viewers hear that stable dividend investing may require hundreds of thousands of dollars to generate meaningful monthly income, it becomes psychologically natural for them to start searching for faster or easier alternatives. The creator clearly understands this mindset and intentionally addresses it before viewers fall into dangerous assumptions on their own. Rather than pretending these higher-yield opportunities do not exist, the video openly discusses them while carefully highlighting the trade-offs and risks attached to each approach. One of the first specialized strategies mentioned is sector-focused investing, particularly within industries like energy. The creator explains that certain sectors of the economy often provide dividend yields in the range of 4 to 5%, meaning investors might only need approximately $250,000 invested to generate $1,000 per month in dividend income. At first glance, this sounds dramatically more attractive than the earlier example, requiring $400,000 for a conservative 3% yield. However, the creator quickly balances this excitement by explaining that concentrating heavily in one industry introduces major risks. Energy companies, for example, are highly dependent on oil prices, global economic conditions, geopolitical events, and commodity cycles that can fluctuate violently over time. During strong economic periods, these companies may generate enormous profits and maintain generous dividend payments. But when market conditions weaken, the same businesses can suddenly experience severe declines in profitability. The creator humorously compares this experience to an emotional roller coaster, emphasizing how difficult it can be for investors to remain calm while watching large fluctuations in both stock prices and dividend reliability. This section subtly teaches the principle of diversification by demonstrating how concentrating too heavily in one sector may increase income potential while simultaneously increasing vulnerability to economic shocks. The video then transitions into discussing real estate investment trusts, commonly known as REITs. This part is especially effective because REITs are often highly attractive to people interested in passive income due to their relatively high yields and the emotional appeal of real estate ownership. The creator describes REITs as companies that own and operate income-producing real estate while being legally required to distribute most of their profits to shareholders through dividends. This explanation makes REITs sound appealing because they allow investors to participate in real estate income without personally managing properties, collecting rent, or dealing with tenants. The speaker even jokes about avoiding late-night maintenance calls from frustrated renters, which helps keep the tone entertaining and relatable. Financially, the creator explains that many REITs offer yields between 4 and 6%, reducing the amount of required invested capital to roughly $200,000 to $300,000 for the target monthly income. Once again, however, the video carefully avoids oversimplifying the opportunity. The creator explains that REITs are highly sensitive to broader economic conditions, interest rate changes, and the overall health of the real estate market. When interest rates rise, borrowing becomes more expensive, property values can decline, and REIT performance may suffer significantly. This reinforces one of the video's central themes. Higher income opportunities nearly always involve additional forms of risk that investors must be willing to tolerate emotionally and financially. The final and perhaps most psychologically tempting strategy discussed involves investing in individual high-yield dividend stocks. The creator acknowledges that some individual companies may offer dividend yields of 6, 7, or even 8%, theoretically allowing investors to achieve the $1,000 monthly income target with as little as $150,000 to $200,000 invested. This possibility naturally sounds extremely appealing because it reduces the required capital dramatically compared to safer strategies. However, the creator delivers another important reality check by explaining that investors choosing this path are essentially placing enormous trust in the management quality, financial health, and long-term stability of a relatively small number of companies. While concentrated investing can sometimes produce excellent results, it also creates substantial exposure to company-specific disasters. A single dividend cut, Earnings collapse, scandal, or industry disruption can severely damage both the investor's income stream and portfolio value. The creator emphasizes how many investors become emotionally attracted to these high-yield stocks, only to later discover that the businesses supporting those payouts were fundamentally weaker than they initially appeared. This reinforces the earlier warning about dividend traps, while also illustrating how greed and impatience often tempt people into taking risks they do not fully understand. Throughout this entire section, the video skillfully balances attraction and caution. The creator never completely dismisses higher-yield strategies, but he repeatedly reminds viewers that increased income potential nearly always comes with increased uncertainty and emotional volatility. By doing so, the video encourages viewers to think critically rather than emotionally when evaluating investment opportunities. Instead of blindly pursuing whichever strategy appears to generate the fastest passive income, the audience is encouraged to carefully consider whether the risks, stress, and instability attached to those investments truly align with their long-term financial goals and personal temperament. Dividend sustainability, dividend aristocrats, and the importance of long-term reliability. After exploring the temptation of high-yield investments and the risks associated with specialized strategies, the video shifts toward what may be its most mature and philosophically important idea: the concept of sustainability. This section represents a major turning point because the creator moves beyond discussing how much income an investment can generate today and begins focusing on whether that income can realistically continue for many years into the future. The speaker emphasizes that successful dividend investing is not simply about receiving the largest possible payments in the present moment. It is about building an income stream capable of surviving economic downturns, recessions, market crashes, inflationary periods, and unpredictable business cycles. In other words, the true challenge is not creating dividends temporarily, but creating dividends that endure. This distinction is extremely important because many inexperienced investors become overly focused on immediate returns without considering the long-term health of the businesses generating those payments. The creator explains that investors relying on dividend income are essentially entering long-term relationships with the companies they own. This metaphor is psychologically effective because it reframes investing as a matter of trust, reliability, and consistency, rather than simply chasing numbers on a screen. Just as people seek dependable partners in personal relationships, investors should seek dependable companies capable of maintaining financial strength across decades rather than only performing well during favorable market conditions. To illustrate this idea, the video introduces the concept of dividend aristocrats, a group of companies that have increased their dividend payments consistently for at least 25 consecutive years. This becomes one of the strongest credibility-building sections of the video because it points viewers toward businesses with long histories of surviving and adapting through multiple economic crises. The creator references companies such as the Coca-Cola Company, Procter & Gamble, and Johnson & Johnson as examples of businesses that have continued paying and increasing dividends through recessions, stock market crashes, inflationary periods, and major global disruptions. These examples are strategically important because they symbolize stability, familiarity, and resilience. Most viewers already recognize these brands from daily life, which subconsciously strengthens the perception that these companies are durable and deeply embedded within the economy. The creator also makes an important observation that these highly reliable dividend-paying companies often do not offer the highest yields available in the market. A company like Coca-Cola, for instance, may only provide a dividend yield of roughly 2.5% to 3%. This means investors still require substantial capital, perhaps around $400,000, to generate $1,000 per month in dividend income. However, the trade-off is that these payments are viewed as significantly safer and more predictable than the unstable payouts offered by highly speculative companies. This reinforces the recurring lesson that sustainable investing frequently requires sacrificing excitement in exchange for reliability. The video subtly teaches that mature investors often prioritize sleep, stability, and peace of mind over the thrill of chasing aggressive returns. Another major idea introduced in this section is the importance of time in building financial independence. The creator acknowledges that hearing large target numbers like $400,000 can initially feel discouraging, especially for viewers early in their investing journey. However, instead of allowing the audience to become overwhelmed, the speaker reframes the problem by emphasizing gradual portfolio construction over many years. This transition is psychologically important because it transforms a seemingly impossible financial goal into a manageable long-term process. The creator explains that successful investors rarely accumulate enormous portfolios overnight. Instead, they steadily contribute money month after month while allowing dividends, market appreciation, and compounding to work together over time. This is where the concept of dollar-cost averaging enters the discussion. Rather than attempting to perfectly time the market or invest massive lump sums immediately, investors consistently add smaller amounts regularly regardless of short-term market fluctuations. The creator presents this strategy as both practical and emotionally sustainable because it removes much of the pressure associated with trying to predict market movements perfectly. By consistently investing over time, individuals gradually build ownership in productive assets while smoothing out the emotional volatility caused by short-term market changes. Throughout this section, the creator repeatedly emphasizes patience as one of the greatest advantages an ordinary investor can possess. While many people search for shortcuts, rapid profits, or secret investing formulas, the video argues that long-term consistency is often far more powerful. The message becomes increasingly clear. Sustainable dividend investing is not exciting in the traditional sense. It is slow, disciplined, repetitive, and sometimes emotionally boring. Yet precisely because it lacks dramatic excitement, it often becomes far more effective over decades than emotionally driven speculation. This philosophy gives the video a surprisingly mature tone compared to much of the sensationalized financial content commonly found online. Rather than glorifying risk-taking or unrealistic returns, the creator frames financial independence as the product of patience, stability, and intelligent long-term decision-making. The power of reinvesting dividends and the snowball effect of compound growth. After establishing the importance of stability, patience, and long-term reliability, the video transitions into one of the most financially transformative concepts in all of investing: dividend reinvestment and the extraordinary compounding effect it creates over time. This section is particularly powerful because it shifts the viewer's perspective from thinking about dividends as simple spending money to understanding them as tools capable of accelerating wealth creation dramatically when handled intelligently. The creator explains that one of the biggest mistakes many beginner investors make is becoming so emotionally excited about receiving dividend payments that they immediately spend the cash instead of reinvesting it back into additional shares. While using dividend income may feel rewarding in the short term, the speaker argues that reinvesting those payments is what truly unlocks the long-term wealth-building power of dividend investing. To make this concept easy to understand, the creator compares reinvesting dividends to planting seeds from a fruit tree rather than consuming every piece of fruit immediately. This analogy works extremely well because it illustrates how small decisions repeated consistently over time can eventually produce exponentially larger outcomes. Each dividend payment used to purchase additional shares increases the investor's ownership stake, which then generates even more dividends in the future. Those larger dividends purchase even more shares, creating a self-reinforcing cycle of growth that becomes increasingly powerful over long periods of time. The creator describes this process almost like a financial snowball rolling downhill, gradually becoming larger and more powerful as it continues moving forward. One reason this section is so effective is because the speaker acknowledges that the early stages of compounding often appear unimpressive. For many beginner investors, receiving $50 or $100 in annual dividends may feel insignificant compared to the larger financial goals they hope to achieve. However, the creator emphasizes that compounding is deceptive precisely because its most dramatic effects occur later rather than earlier. During the initial years, progress can appear painfully slow, causing impatient individuals to lose motivation or abandon their investing strategy prematurely. Yet over time, as reinvested dividends continue purchasing more income-generating assets, the rate of growth gradually accelerates. The creator uses a practical example involving an initial $50,000 investment in a 3% yielding dividend fund. In the first year, the investment generates approximately $1,500 in dividends. On its own, this amount may not seem life-changing, but once those dividends are reinvested, the portfolio itself becomes larger. In the following year, the investor earns dividends not only on the original investment, but also on the newly purchased shares acquired through reinvestment. This process repeats continuously, causing the portfolio to compound internally year after year. The video explains that after a decade of reinvesting dividends, the portfolio value and annual income becomes significantly larger despite the investor never contributing additional money beyond the initial investment. Over 20 years, the effect becomes even more dramatic, demonstrating how time itself becomes one of the investor's most valuable assets. This section subtly teaches one of the deepest truths about investing. Wealth creation is often less about earning extraordinary returns and more about allowing consistent returns to compound uninterrupted for very long periods of time. Another important aspect of this section is the way it reframes patience as an active financial strategy rather than passive waiting. The creator argues that while many people search for constant excitement, rapid profits, or high-risk opportunities, truly effective wealth building often feels almost boring in the short term. Dividend reinvestment does not usually provide dramatic emotional highs, but its long-term mathematical impact can become enormous. This is psychologically significant because modern financial culture frequently glorifies fast-moving speculation, daily trading, and sudden success stories, while underestimating the quiet power of disciplined compounding. The creator intentionally positions reinvestment as something almost magical, describing it as money continuously working to create more money, while the investor focuses on ordinary life activities. This imagery helps reinforce the emotional appeal of passive income, while simultaneously grounding it within realistic financial principles. The video also uses this section to reconnect viewers with the larger theme of time horizon. The creator repeatedly implies that successful investing is not about predicting short-term market movements, but about maintaining consistent participation in productive assets for decades. Reinvestment amplifies this idea because the longer the process continues uninterrupted, the more powerful the compounding effect becomes. In many ways, this section serves as the emotional and mathematical heart of the entire video, because it transforms dividend investing from a simple income strategy into a system capable of gradually building financial independence through patience, consistency, and the relentless mechanics of compound growth. Taxes, retirement accounts, and the hidden realities most investors ignore. After explaining the power of compounding and dividend reinvestment, the video moves into a more practical and often overlooked area of investing by discussing taxes and the role of retirement accounts. This section may not sound as emotionally exciting as passive income or dividend growth, but it significantly increases the credibility and realism of the entire presentation, because it addresses the financial friction that many beginner investors fail to consider when calculating future income goals. The creator openly acknowledges that taxes are not an enjoyable topic, humorously comparing them to unpleasant experiences people would rather avoid discussing altogether. However, the speaker emphasizes that ignoring taxes while planning dividend income is similar to planning a long road trip without accounting for fuel costs. In other words, taxes are an unavoidable part of financial reality, and failing to include them in investment planning can create major disappointments later. This honesty strengthens the educational value of the video because it reminds viewers that generating income and keeping income are not always the same thing. The creator explains that dividend payments received inside a standard taxable brokerage account are generally considered taxable income. Depending on the type of dividend and the investor's tax situation, a portion of those payments may be owed to the government each year. Some dividends qualify for favorable tax treatment and may be taxed at lower capital gains rates rather than ordinary income rates, but the essential point remains unchanged. The gross amount received from dividends is not always the amount investors ultimately keep. This realization becomes extremely important when calculating passive income targets. Someone hoping to live on $1,000 per month in dividend income may actually need to generate substantially more than that before taxes in order to maintain the desired lifestyle after taxes are deducted. The creator uses this point to subtly shift the viewer's mindset toward more comprehensive financial planning. Passive income is not simply about maximizing cash flow. It is about understanding the entire financial system surrounding that income, including taxation, account structure, and long-term compounding efficiency. The video then introduces tax-advantaged retirement accounts such as IRAs and 401(k)s as powerful tools capable of accelerating wealth accumulation. These accounts are presented almost as strategic shelters where dividends and investment gains can compound more efficiently because taxes are either deferred or reduced under certain conditions. The creator explains that when investments grow inside these types of accounts, the investor avoids losing a portion of their returns to annual taxation year after year. This difference may initially seem small, but over long periods of time, avoiding repeated tax drag can dramatically increase total portfolio growth. This concept connects directly back to the earlier discussion about compounding because even small reductions in yearly losses can create substantial differences after decades of reinvestment. The creator frames retirement accounts as long-term allies for investors pursuing financial independence, especially those focused on building future income streams. However, the video once again avoids oversimplifying the situation. Rather than portraying retirement accounts as perfect solutions, the speaker also explains their limitations. In many cases, withdrawing money too early from these accounts can trigger penalties or restrictions, meaning the investor may not have complete flexibility over when the funds can be accessed. This becomes particularly relevant for individuals dreaming of achieving financial independence at younger ages rather than waiting until traditional retirement years. By acknowledging both the benefits and drawbacks of these accounts, the creator maintains the balanced and realistic tone that defines the entire video. Another important transition occurs in this section when the creator addresses a controversial but intellectually honest point about dividend investing itself. The speaker openly admits that focusing exclusively on dividend income early in one's investing journey may not always be the mathematically optimal strategy for maximizing total wealth. This is one of the most mature observations in the video, because many finance creators become emotionally attached to a single investing philosophy and refuse to acknowledge competing perspectives. Here, however, the creator explains that companies paying large dividends are distributing profits to shareholders rather than reinvesting those profits back into expanding the business. For mature companies with limited growth opportunities, this may be entirely reasonable. However, younger companies with strong growth potential may generate greater long-term returns by retaining earnings and reinvesting them internally rather than paying large dividends immediately. This leads into the broader concept of total return investing, where the investor focuses not only on dividends received, but also on overall portfolio appreciation. The creator suggests that growth-focused investments may sometimes help investors build wealth faster, even if those investments produce little immediate passive income. Instead of requiring $400,000 to generate $12,000 annually in dividends, an investor might potentially accumulate $200,000 in faster-growing assets and periodically sell small portions to create equivalent yearly income. This idea challenges the emotional comfort associated with dividends because many investors psychologically prefer receiving cash payments over selling investments, even if the mathematical outcomes may sometimes favor growth strategies. The creator handles this tension very skillfully by refusing to dismiss the emotional satisfaction dividends provide. Instead, the video acknowledges that the psychological motivation created by regular dividend payments can itself become valuable if it encourages investors to remain disciplined and committed during difficult market periods. This balanced treatment of both mathematics and human psychology is one of the reasons the video feels more thoughtful and nuanced than much of the simplified financial content commonly found online. Ultimately, this section reinforces the broader message that successful investing is not about blindly following one ideology, but about understanding trade-offs, taxes, personal behavior, emotional comfort, and long-term financial objectives together as part of a complete strategy. The deeper psychological meaning of dividend income and why the video resonates so strongly with viewers. As the video approaches its conclusion, it gradually becomes clear that the discussion is no longer only about financial calculations, dividend percentages, or portfolio strategies. Beneath the surface, the creator is exploring something much deeper and far more emotionally powerful: the psychological meaning people attach to passive income and financial independence. This is one of the main reasons the video resonates so strongly with audiences. The subject may appear technical on the surface, but emotionally it taps into universal human desires such as security, freedom, control over one's time, and relief from financial anxiety. Throughout the entire presentation, the creator repeatedly frames dividend income not merely as money, but as a symbol of independence from constant labor. The opening image of receiving income while peacefully drinking coffee at home becomes a recurring emotional anchor, because it represents an alternative lifestyle where survival is no longer directly tied to exhausting daily work. For many viewers, this fantasy carries enormous psychological weight. They are not simply calculating investment returns. They are imagining a life with reduced stress, greater flexibility, and the ability to make decisions without constantly fearing financial instability. The video understands this emotional motivation extremely well and continuously reinforces it through calm storytelling, humor, and relatable examples rather than aggressive sales tactics or unrealistic promises. Another reason the video feels psychologically effective is because it acknowledges the emotional comfort many investors derive from receiving actual cash payments. Even though the creator openly admits that pure growth investing may sometimes produce superior mathematical returns, the video refuses to dismiss the emotional power of dividends themselves. Watching portfolio values fluctuate on a screen can feel abstract and uncertain, especially during volatile market conditions, but receiving regular dividend payments creates a tangible sense of progress and stability. Investors often experience these payments almost like miniature paychecks generated by their assets instead of their labor. This emotional experience can significantly increase motivation, discipline, and long-term commitment because it provides visible evidence that the investment strategy is actively producing income. The creator recognizes that investing success is not purely about maximizing numbers on paper. It is also about maintaining behaviors and habits that people can psychologically sustain for decades. In this way, the video treats investing not only as a mathematical process, but also as a behavioral and emotional challenge. The creator repeatedly emphasizes patience, discipline, consistency, and emotional control because these qualities ultimately determine whether individuals remain invested long enough to benefit from compounding. This perspective is particularly important in modern financial culture, where many people are constantly exposed to stories of rapid wealth, speculative trading, cryptocurrencies, viral stock movements, and extreme short-term gains. Against that backdrop, the video almost feels intentionally calm and grounded. Instead of glorifying excitement, the creator repeatedly suggests that successful wealth building often appears boring, repetitive, and emotionally uneventful in the short term. Ironically, that very lack of excitement is portrayed as a strength rather than a weakness, because emotionally stable strategies are generally easier to sustain over long periods of time. The video also uses humor strategically to make financial education feel less intimidating. Jokes about office donuts, roller coasters, Netflix binge-watching, and awkward work reviews help maintain audience engagement while simultaneously lowering the emotional barrier many beginners feel toward investing topics. Financial education can often sound cold, overly technical, or intellectually intimidating, but the creator intentionally adopts a conversational tone that makes viewers feel comfortable rather than judged. This approachable communication style likely contributes significantly to the video's retention and shareability, because viewers feel as though they are learning from someone relatable rather than being lectured by a distant financial expert. Another subtle psychological strength of the video is its balanced credibility. The creator never presents investing as easy or risk-free, yet never becomes overly pessimistic either. Instead, the audience is consistently given hope combined with realism. This combination is extremely persuasive because viewers tend to distrust content that sounds either too optimistic or too negative. By openly discussing taxes, dividend cuts, market volatility, risk management, and the trade-offs between growth and income investing, the creator builds trust while still preserving the emotional appeal of financial independence. The result is content that feels mature, thoughtful, and emotionally authentic rather than manipulative. Ultimately, the deeper message of the video is that financial independence is not reserved exclusively for financial geniuses, wealthy insiders, or professional traders. Rather, it is presented as the cumulative result of ordinary people making disciplined decisions consistently over long periods of time. Dividend investing becomes symbolic of a larger philosophy centered around patience, ownership, delayed gratification, and building systems that gradually reduce dependence on active labor. This emotional and philosophical layer is what elevates the video beyond a simple explanation of dividend yields and transforms it into a motivational narrative about long-term personal freedom and financial self-determination. Final conclusion, overall evaluation, and the true lesson hidden inside the video. By the end of the presentation, the video succeeds in accomplishing something that many financial content creators struggle to achieve. It educates, motivates, and emotionally reassures the audience at the same time without relying on unrealistic promises or exaggerated displays of wealth. Although the title focuses on the practical question of how much money is required to generate $1,000 per month in dividends, the deeper lesson hidden beneath the surface is actually about the mindset necessary to build lasting financial independence. The creator repeatedly demonstrates that passive income is not the result of luck, secret shortcuts, or sudden financial breakthroughs, but rather the consequence of long-term discipline, intelligent risk management, patience, and consistent investing behavior sustained over many years. One of the strongest qualities of the video is its balance between aspiration and realism. Many finance videos online either lean too heavily into fantasy by promising rapid wealth and easy success, or they become so technical and emotionally detached that viewers lose motivation entirely. This video carefully avoids both extremes. It allows viewers to dream about a life where investments generate income automatically, but it also grounds those dreams in realistic mathematics and practical financial principles. The creator never pretends that building a meaningful dividend portfolio is easy. In fact, the repeated emphasis on needing hundreds of thousands of dollars for substantial passive income actually increases the credibility of the message, because it reflects economic reality rather than social media fantasy. At the same time, the video consistently reassures viewers that these goals become achievable when broken down into smaller long-term actions such as regular investing, dividend reinvestment, dollar-cost averaging, and maintaining patience during market fluctuations. Another reason the video feels effective is because it consistently frames investing as a process rather than an event. The creator subtly teaches that wealth is usually built gradually through systems and habits instead of dramatic financial decisions. This perspective is psychologically powerful because it reduces the intimidation associated with large financial goals. Instead of telling viewers they need $400,000 immediately, the speaker explains that most successful investors build portfolios slowly over decades, allowing compounding and time to do much of the heavy lifting. This shift transforms financial independence from an impossible dream into a realistic long-term direction. The video also deserves credit for presenting multiple investing philosophies without becoming overly ideological. The creator discusses conservative dividend investing, growth investing, balanced portfolio strategies, REITs, sector investing, and high-yield individual stocks while openly acknowledging both the strengths and weaknesses of each approach. Rather than presenting a single universal formula, the content encourages viewers to think critically about risk tolerance, emotional comfort, lifestyle goals, and long-term sustainability. This intellectual honesty makes the video feel more trustworthy because real investing rarely involves perfect answers or risk-free solutions. Another important strength is the emotional maturity of the presentation. The creator repeatedly warns viewers about greed, unrealistic expectations, and the temptation to chase unsustainable yields. At the same time, the video avoids fear-based messaging and instead promotes calm, rational decision-making. This balanced emotional tone is particularly valuable in an era where financial media often thrives on urgency, hype, fear of missing out, and constant excitement. The creator almost positions boring consistency as a competitive advantage, suggesting that emotionally stable investing behavior may ultimately outperform emotionally reactive speculation over long periods of time. This philosophy gives the video a surprisingly grounded and responsible tone compared to much of the highly sensationalized finance content commonly found online today. The use of storytelling, humor, and relatable analogies also contributes significantly to the video's overall effectiveness. Concepts like dividend traps, compounding, and sector risk can easily become dry or overly technical, but the creator consistently translates these ideas into everyday comparisons that make them easier to remember and emotionally understand. References to Office Donuts, roller coasters, Netflix, and awkward performance reviews help humanize the discussion and maintain audience engagement without sacrificing educational depth. This communication style likely explains why the video feels accessible even to viewers with little prior investing knowledge. Ultimately, the true lesson of the video extends far beyond dividends themselves. The creator is really teaching viewers how to think differently about money, ownership, and time. Instead of viewing income solely as something earned through labor, the audience is encouraged to think about building systems of ownership capable of generating cash flow independently. Dividend investing becomes symbolic of a larger transition from working for money toward gradually allowing assets to work on one's behalf. However, the video also makes it clear that this transformation requires patience and emotional discipline, because meaningful passive income is usually built slowly rather than discovered suddenly. In the end, the final message is both simple and surprisingly profound. Financial freedom is not reserved for extraordinary people with secret knowledge, but for ordinary individuals willing to consistently invest, reinvest, remain patient, and think long-term while most others search for shortcuts.